we went back and forth on some of the details, and in midstream, the seller sold it out from under her listing broker's agreement.
Welcome to CREPN Radio for influential commercial real estate professionals who work with investors, buyers, and sellers of commercial real estate coast to coast. Whether you're an investor, broker, lender, property manager, attorney, or accountant, we're here to learn from the experts.
Welcome to Commercial Real Estate Pro Network's CREPN Radio. Weekly, we share interviews with real estate experts passing on their experience and knowledge. This is episode number 73. Thanks for joining us this week. My name is Jader Gross. We're so glad you're here. We are always on the lookout for information that can help you move your real estate investing to the next level. Normally, we have a guest, but today's episode's a little different. Two ways. There's one, it's end of the year. So we're going to do a little end of the year wrap up. I'm certainly grateful for you for tuning in and for all of you that have tuned in over the past year. And I'm also grateful for all the guests we've had. And I'm looking forward to a great 2017. The other thing is I want to let you in on what I learned and what I did with it. In case you didn't know it, a lot of the guests are people I've sought out because I'm working on something, and I thought they could help me figure things out. And it might be kind of sneaky, but I've found that I learn the best when I'm interested in something or when I've got a problem that I need to solve. And so today I'm going to share with you about our first apartment purchase, and we'll get into that in just a minute. But before we do, I want to say if you're a returning listener, thanks for coming back. If you're a first-time listener, thanks for checking out Commercial Real Estate Pro Network's podcast. If you like what we're doing, certainly hope you'll subscribe to the program. There's a couple different ways you can do that. You can either go to commercialrealestatepronetwork.com, and on the menu bar, go ahead and click the link podcast. And then once you get to the podcast page, go ahead and click on the link that says subscribe. And there you can choose from either iTunes or Stitcher. It's really easy. Or if you already use iTunes or Stitcher, just go to the one you like, and in the menu bar, type in Commercial Real Estate Pro Network, or I guess the search bar that is. Type in Commercial Real Estate Pro Network. And when you see our logo pop up, it's the headphones with CREPN. That's capital CREPN. Between the ears, go ahead and click subscribe, and you're set. That way you can hear any program we post. And again, a couple ideas we're working on right now for the next year. We're working on a couple of additional topics that we're going to try and make a regular occurrence. But it's the couple of topics are first deals and also insurance claims. And I spoke with an attorney today that I think might be very, very helpful in providing some warning and also some educational value for landlords and tenants, landlord-tenant laws, and also just real estate transactions as well. So keep that in mind. A little more incentive to subscribe. We'd love to have you join us. If you're on Facebook, Twitter, or LinkedIn, go ahead and look me up, reach out and connect. What's really cool about this is, I get these invites to connect, and all I'll say is that if you do that, please go ahead and let me know that you listen to the program, so I have some sort of frame of reference. Sometimes I get these requests to connect, and I'm like, how do I know this person? But I'm pretty open to it, so go ahead and do that. But like I said, go ahead and let me know that you listen to the program. It'd be a big help. If you are working on a deal and you'd like to talk about it, or if you have any kind of a question on insurance, go ahead and reach out to me as well. My contact information is on the website, commercialrealestatepronetwork.com. The email is Darren, D-A-R-R-I-N, at jdarrengross.com, or you can also reach me by phone. My phone number's on the website as well. Either way, if you'd like to talk through a situation, let me know. I enjoy it. It's usually good for me, and I think it's generally good for most to be able to talk through something, get an alternative view. And if there's anything I can do to help, let me know, and I'll do what I can. That's what I like to do. And lastly, before we get on with the show, if you're on LinkedIn, check out our group, Commercial Real Estate Pro Network. It's a great place to network with commercial real estate professionals. And, that's about all I got for that. All right, so let's get on with the show. So, like I said, today's show is a little bit different. We don't have a guest. I'm actually going to tell you a little story about my wife and my first apartment purchase. Up until recently, we've been investors for 20 plus years, and but all of our deals have been single family, or we've done some single family homes that have been used as group homes. And like I said, we've been doing this for over 20 years, but for the longest time, the properties and the strategy was more of a retirement thing. I looked at it as kind of a pension fund. I figured that if I could buy these properties, get them paid off by the time I wanted to retire, that the income, if you take the income and you pay the taxes and insurance and repairs and any kind of vacancies, essentially you could expect to retain half of whatever you took in. So if you had real easy math, if you had a $10,000 in annual rent, say $1,000 a unit, 10 units, that'd be $10,000. Monthly, you could expect to have $5,000 in income with inflationary consideration as well. So it would hold true through inflationary periods. What happened over time is we purchased a group home. I actually built a group home, and along the way, I really learned that these things could cash flow, as opposed to just this strategy of eventually they'll be paid off, but actually make some money on it. And I couldn't have done that if I hadn't run into a tool. And I make it available. And if you look in the show notes, there's a link to it. I've made it available to anybody who wants it. But I call it a deal workbook. And essentially, it's a 4-page spreadsheet that works you through from the elements of the deal. And what I mean is, where are you going to get your money? What are all the costs associated with the deal? Whether it be taxes, insurance, the acquisition costs go on down. Whether you're building new construction or you're buying an existing property that needs remodeling, you can account for all of that. So you get your working budget. Then it has an operational budget where you can actually put in your rent, the rent collected, if there's any kind of laundry fees or whatever else might possibly be. If you've got tanning beds or whatever that is, you can put that in there. It's very fluent and allows for the projection out for 30 years. And then and it also includes some estimates on what you think your annual rent escalations will be, and also for vacancies. I mean, it's a really great tool. And lastly, the sheet that really brings it all together, there's an expense sheet. So all of a sudden, your eyes are open wide to see all of the expenses that are associated with renting or owning real estate, whether it be insurance, taxes, property management, some sort of a sinking fund for replacement of items, attorney, accountant, and then it also has a mortgage calculator, so you can determine, how does the property pencil if you are able to borrow money at, a rate of say 5.5%. Well, what happens if you get it down to 4 3/4, right? And then likewise, you can see what happens if you put in a rent at say $500 a month, and you realize it's way undervalued. But then you go and you put in a rent of $800 a month, and you can see how the numbers will work there. So again, I can't stress enough how the value of this tool, and I'll get into it on how it worked with me in this process for our first property. But my point is that we invested for a long time, kind of slow and steady, the slow ski model there of one at a time. We got up to 6 properties. We started accumulating some cash, had a property that was free and clear, leveraged that to get into another property that we then had free and clear. And it was about a year ago that we consciously made the decision that we wanted to get into something larger, more of a commercial property. And by definition, I think most lenders look at a commercial property as a 5+ unit if it's residential, if it's retail or something, or some sort of commercial enterprise going on in the property. I think most lenders look at it that way. And the important distinction in that is that if you go buy a single-family property, they look at you, the borrower. Whereas if you're buying a commercial property, they're looking at what is the economic potential of the property. And that's important because if the property doesn't make money and can't afford to pay the debt, the bank won't support it, right? Whereas if you're buying a property that's a single-family property that's on the MLS, and you have enough income to support it, they'll let you buy it because they recognize that the property, or they're not looking at the property to be the main revenue source. They're looking at your work activities to support that. So anyway, the worksheet is a huge, powerful tool. I encourage you to go check that out. So a year ago, we make the decision we're going to get into some multifamily, and this. The first thing I think that, once you decide you're going to get in, where are you going to do it? We live in Oregon. All of our properties to date have been in Oregon. But we frequent Florida. My in-laws live down in Florida. My wife loves Florida, the sunshine and the warmth that brings as opposed to the cool and less enjoying cold, wet atmosphere that has come to it doesn't work for her as well as it did at one time. So, but anyway, so with that in mind, we started to look towards Florida as to the place where we would like to have a property and start to migrate that way with our investments. And so naturally, I had my wife. I said, "All right, well, let's figure out where we want to do, what we want to do. What's it look like down there?" So she was down there visiting her mother, and she kept telling me about all these properties she was finding. And the first one that we looked at, it was kind of an unconventional. It was a gentleman that owned, I think it was three. They're actually duplexes. They were built as duplexes, but they were used as triplex. And it was just kind of an odd deal. I mean, the property was built a certain way. It was being used in another way, and it just had some. It was not a conforming property. It was not being used as it was intended, and the numbers were a stretch to make it work, kind of thing. And it was actually being priced more like single family or duplex as opposed to an actual multifamily deal. So we looked at that, kind of shied away from that. But then we found there was another property. It was a 12-unit, 1-story, 2 buildings, 6 units each, block construction, joist roof. It was a great property. We were all excited. We got it under contract. We went back and forth on some of the details, and in midstream, the seller sold it out from under her listing broker's agreement. I mean, it was like the weirdest thing, and neither the listing broker or the buying broker had ever seen that before. So we lost out on that, which was kind of a frustrating thing. And my wife, she was pretty shook up about it. She just felt like we weren't going to get there based on what was happening. So a little while longer, we found another property. It was again a non-conventional. It was very, I think there was like 4 buildings built at various different times and all sorts of overgrown vegetation and just kind of a rougher property. And the broker we were working with, he actually saved us from it. He went down and took a look at it, and he says, "We are not doing this." I mean, it was in rough shape and not what we were looking for. And that led us to from a scary looking property to a vacation rental looking thing. It was a beautiful property. It was about just across the street from the beach. The problem with that one was the numbers never added up, and we got all the way into that thing. We had the inspections done, but where we ran into trouble was the lending. Single from a 4-unit standpoint, we had one lender was looking at it from a residential option, but because the property hadn't been seasoned, it didn't have 2 years worth of rents to show for it, and there was a property we had that had actually had a tenant that had been in a property for 15 years move out. We had some expenses that seemed inordinately high to the lenders for this one property. It really became kind of a difficult situation. And then on the commercial lender, they were offering me some sort of a quarterly adjustable rate loan, and I was saying, "Hey, are you guys reading the paper? There's a lot of things that aren't looking good on that kind of loan," and so we ended up killing that deal. But not to be discouraged, my wife, she continued to look and look and look, and whether it was on LoopNet or Zillow or wherever, she continued to look, and she showed me a property that she kind of went past, didn't really look at it too closely, and I looked at it, and I think what scared off at first was the asking price. The asking price was like almost $1 million. It was 12 units, and I took a look at it. And two of the things that I learned when we were looking at that vacation property was that in Florida, wood structures are kind of tough because there are some pests down there that in Florida that can destroy a property in a hurry. And so that was something that we learned about, and it kind of made me not want to, end up with something that I could have the pest or termites, destroy kind of thing. The other thing was I learned a lot about flood insurance. This property that we were looking at, this 4-unit property, was actually in a flood zone. And flood insurance, anytime you have to have flood insurance, it's expensive. If you live on top of a mountain, very affordable. But if you're in low-lying areas, in an area that has a history of flooding, you're going to spend a lot. And so there were just some numbers, and it really wasn't fitting together. And it was just, I was working the numbers day and night, trying to figure out how can we make this thing work. And I wasn't getting any reassurance from anybody. And I was very actually relieved when we pulled the plug on the deal, because it just did not feel like something that was going to work. And so anyway, we continued on, and we worked, and we looked, and we found this one property. And like I said, the first two things I realized is, A, it was not in a flood zone. B, it was not made out of wood. It was a concrete block construction. So it had two things that I was excited about. The configuration was a 2-story block. It was 12 uniform units. They were, 1 bedroom, 1 bath. We got to know a broker in the area and realized that it was well underpriced as far as the rents. The rents were anywhere from almost half of what the market would support to a third under what the market would support. And we also learned that this deal had actually had a sale fail because of the prior purchase agreement failed because the borrower couldn't or they couldn't get funding, couldn't get the financing. So with all that we had learned about all the deals, the ins and outs, and all that fun stuff, I made the decision to find a bank and lay all my cards out on the table and identify with them what exactly I intended to do, and to see if we couldn't get a commitment from the bank first, so that when we made the offer, and also when I say have a commitment from the bank, I wanted something in writing from the bank that I could present with our offer, so that they knew there was not a some pie in the sky kind of thing. Because I recognize that especially if the seller had a sale fail, he's probably going to could be a little gun shy about who's this guy he doesn't know. So anyway, we made an offer based on what the numbers supported. We didn't go based on what the seller was wanting or was what the listing price was. And that was another thing I learned on that vacation unit thing. There was the selling agent was also the owner of the property, and in the conversation and negotiations, they made it known that they had a full cash, or they had a cash offer backing ours up. And I found that kind of troubling, because if I had it to do over again, I think at that point I said, well, excuse me, I'm sorry, I didn't mean to get in your way. You need to go do that cash offer, because clearly you've got a cash offer. Go do the cash offer. Otherwise, you wouldn't be telling me about the cash offer. And either call their bluff or just get out of the way, because it created some noise, if you will, in the conversation that was not helpful. So again, I tell you that because it kind of fueled my thinking on the offer that we made, in that we're offering less than what you're asking, but we have the financial backing to do what we're doing or what we're offering. And so how did I know that it would fit? Well, we ran the numbers, and I can't stress that enough. We ran the numbers. We used this deal workbook. Again, I can't stress enough. If you want to see it, click on the link. It's in the show notes here. It's also on commercialrealestatepronetwork.com. But I make it available to anybody that wants it. But it helped us recognize the numbers for what they were, what the property could support, where there were some expenses that we could trim, and what it would look like once we go through a transition period. Because obviously now that we control the property, we are working to adjust these expenses and also get the rent increases so we can actually so the property performs as we projected. Okay, let's talk a little bit about the numbers. So this property that we purchased, it was listed for just under $1 million. I think it was like $995,000. A lot of money. And the interesting thing was, as we got into it, what we learned were the landlord was paying for the water. They were paying for cable, and also the rents they were charging. The rents were, I think the high was like $520 a month. The low was in the high threes. So incredibly low rents. We did our research. We found that the market rents were closer to $800 a month, and that cable is not necessarily necessary. We also found out that when we were running our numbers, I like to run very conservative numbers. We ran them at about, I think it was running like a 5.5% interest rate, is just to be safe. We were able to get 4.75 on our 25-year loan with a 5-year fixed, then it adjusts and continues on. So we are extremely optimistic. We have, like I said, we've got a couple things we have to work through. We have to first send notice to our residents that the water rub systems and also the rent increases are going to be happening, and we're working through that right now with our property manager on how to do that. But I think the plan right now is to identify the 4 units that are paying the least and address those first, and we'll let them know that the rent's going to be going up, but we're going to be doing some things to go in and spruce up the units. If they'd like to stay, we'd love to have them, but it'd be at a higher rent than what they're currently paying. And then if that's not the case, then we'll go and get market rents. But it's in a desirable area, and we're looking forward to getting the numbers working. And so here we are. We ran the numbers. We made the offer, counter offer, And both the selling broker and our broker recognized that, maybe a little give. I think they even gave up a little bit of their commission to get the deal done, kind of thing. And long story short, and again, I apologize for the length of this story, but we were able to get to a deal. And 60 days after we signed the contract, we closed on the property. Some of the numbers here, I'll give you. I mentioned that we had this one property we had paid off. We were able to walk into our local community bank here in Oregon, and it's a commercial bank, and borrow against that property with basically, again, just showing them our numbers. They had the Tuesday morning loan committee meeting. I got the call later that day saying, hey, we're approved. Just let us know when you want the money. And the property that we're borrowing against has more than adequate income to support that loan. We got into this other property. Like I said, we're working through the rent increase and the controlling the expenses, and everything else that goes along with it. But I'm excited for the journey. We're excited. Couldn't be more happy to actually be in the game with a commercial real estate property or commercial property, and an income producing property at that. And so who did I learn from this last year that helped me? I mean, I've had a lot of guests on the show. I think the show count number, I think we were at 26 at the end of 2015, and this is episode number 73. So that's roughly 40. Is that right? About 40. We didn't quite get 52, but actually I should say almost 50 episodes. So I'm happy that we were able to get that that many episodes added this year. But some of the guys that I want to call out and thank for providing me some insight and their knowledge and sharing here on this podcast. Jake and Gino, if you haven't heard them, they're actually a guest a couple of times. They have their own podcast and their website, Wheelbarrow Profits, and encourage you to check them out. In fact, I'm going to list all these episodes of the guest here that I'm referring to in the show notes. Their concepts and what they refer to is the three legs of the wheelbarrow, and the first leg is the buy right, and it's so true. If you buy right, you've got a chance. If you don't buy right, you're going to be screwed. From there, it's finance right, and again, had the opportunity to finance wrong on a property, and would have been just upside down and just screwed for a long time to make that thing work. And then the last piece is a manage right. And they brought up some topics that I think are definitely worth reviewing. And one of them was the RUBS, the rational utility billing systems, because we're going to institute it in this property to take back some of the or push back some of the costs to operate the property back to the residents. And so those guys, Jake and Gino, if you haven't listened to them, I can't encourage you enough to go check them out. They're a lot of fun, and they've done very well. And at last count, I think they were right under 700 units. They may have added some, but they're investing there in I believe it's Knoxville, Tennessee. Another guest we had, Michael Blank. Michael is a coach. He also encourages you to invest in not just a single family, but get into the multiples. And he talks about the sample deal workbook, and his philosophy is, you've got to get in, you've got to get the education, and you've got to do the exercises to educate yourself. And the way you do that is kind of like doing math. Is you continue to do the exercise, you learn how to evaluate a deal, and you continue to do that to where when the right deal comes up, it's a good deal, and you don't just buy something just because you want to buy something, but you're actually buying a good deal. And I fully support his thinking. We had Joe Fairless on the show earlier this year, and if you haven't listened to Joe Fairless's, he's got a daily podcast. And I mean, talk about a daily, I mean, every single day knocking out a podcast. Now, I'm sure he warehouses some so that he can take some time off and stuff, but every day there's a new podcast being posted, and it's a great resource. If you haven't checked that out, I highly recommend it. And a lot of his guests have given me great ideas. In fact, like I said, when he was a guest on here, he shared with how he accomplished his first deal and how he's worked his syndications. We also had Brandon Turner from Bigger Pockets. If you haven't checked out their program, Bigger Pockets is a great resource. There's a community of real estate investors, and they've got a great show. Josh and Brandon do a great job on their podcast as well. Some other people that were helpful. Timmy Ryerson, she's got a property management software that we're going to use. And again, in the show links, check all these out. But I interviewed her and actually shared that with our property manager. And we're going to be using the software that Timmy's company has. And then another one that comes to mind is Bill Smith. Bill Smith was a cost segregation provider, and the ability to accelerate the depreciation on your building is of value, and to generate more cash up front. And so he's a tremendous wealth of information. I encourage you to check that out as well. And also a couple other guys that come to mind. John Wilhoit. John is he's an investor. He's an asset manager. He's just a wealth of information. He taught me about the different classes of properties, the different markets, and it's been very useful to more, I guess, the ability to communicate. I'm kind of fumbling right now, but the ability to articulate what it is in the marketplace, that where we're going, and understand why it is. And then trying to think, there's also Jonathan provided additional information on the repair regulations, and that was useful as well. So I just want to say I'm extremely excited. I'm grateful for, again, all these guests. And there's many other guests we had throughout the year that I don't want to discredit anybody, because I've learned a lot from almost everybody that's been on the program. And again, I always find it interesting, useful, and I hope that it's worked for you as well. Well, that's all we've got this week. I hope 2016 has been a good one for you. Let's make 2017 even better. And I just also want to say that we know you're busy. We thank you for making time for us today. We do appreciate you. Until next time, thanks for listening to Commercial Real Estate Pro Network's CREPN Radio.
You're listening to CREPN Radio for influential commercial real estate professionals. For more information on this or any of our guests, like us on Facebook, CREPN Radio.